mutual funds and ETF returns. It's kind of interesting because this really is a big area. You have a whole bunch of different venues in this whole realm of mutual funds. And what you end up happening is instead of you competing against program trading and the computers at micro speed, you're kind of hiring somebody to compete against them and work at the same speed. There's a lot of things about the returns, and you have all the different options. And here's some more that you need to know about for mutual funds and also ETFs in just a little bit. Income distributions, payment of interest and dividends to the shareholders. If that's what you want, you can actually get a check out of your mutual fund portfolio in the process, or you can plow it right back in. It just depends what you want. And usually those are choices that you make with a simple click of your computer mouse in the process. Unrealized capital gains, like that stays right there in the fund and life is good, or realized capital gains where the fund sells the securities that increase in value and they have a higher increase overall. So here's an example of a mutual fund. You got to pay attention to it. In essence, really the fund costs you 276.325 shares. Yes, that 0.3245 is a big deal. Actually, it is because you get to buy portions of shares. And if you plow the money consistently back into the mutual fund, you'll see your shares increase and as well as the overall value of it. So you have really, it's $38.10.9 per share when it comes down to it. So you end up having an income distribution and you have a capital gains distribution. You combine them together and then figure out exactly how much money that is for all the shares you have. So you end up having $485.23. So you get the cash value of that, or if you're set up properly, you can sit down and purchase 13.34761 more shares of your fund. It's really kind of cool because of the fact that all of a sudden now you're getting a larger amount in your fund. And if you don't need to have the money in your pocket and want to just reinvestment, you have an automatic reinvestment machine going on and on and on. So it's a really positive thing. If you look over here on the overall, how much you have by category, you can see some of the different things by the blends that you have or the growth, whichever one that you're choosing. 5, 10, and 15-year returns, you have the large blend, the large growth, the large value. But look at the mid cap. I mean, the mid cap is keeping right up there. And even the small value, it really is staying there. On the 5-year ratio, you'll see it keeps up with a lot of the large blend. So really, the aspect of diversity is a big deal. Long term, it depends what your focus is, but overall, pay attention. Frankly, if you really love this kind of stuff, pay attention to it, create your own portfolio and have all these on your portfolio, a large blend, a large growth, a large value, and a mid-cap blend. And you can actually do that if you choose to do that because of the fact you don't have to buy a whole share or buy 100 shares. So it's a little bit different investing process than for stocks and bonds on a regular basis. You'll see star ratings, and then star ratings come and go. So you have 4 stars or the 5 stars, or you can have 2 stars. It depends what they're out there. So pay attention about what you want in your funds. And do you want to have a high risk? Because normally higher risk means more return, or do you want to have a blend, or do you want to be safe? So it depends what you want, and sometimes what you want will vary at your age as to what your needs are. Yes, you're living a wild life over here by yourself, and all of a sudden now you got 3 children. So all of a sudden you got to sit there and change your strategy to fit your lifestyle, and maybe you need to have a safer strategy. And then the children move out, and all of a sudden now you're empty nest. You can go wild again. Yes, and get out there in the process. So it depends what you're doing. Pay attention and make your appropriate changes in your investment portfolio according to your lifestyle and what you need for the moment or for the next 5 years or maybe the next 30 years. So that being said, tradable fund shares, the ETFs, they mimic an index. I kind of like this because there's a lot of good indexes out there. It depends where you're at. Of course, my favorite is always the S&P 500. That's a really cool index because of the fact you have this big giant block of securities out there. And if you have something that mimics that, all of a sudden now you can sit there and watch the market come and go and wax and wane. And the S&P 500 consistently has delivered a relatively decent return on investments. It can be traded in the market rather than only at the end of the day for an ETF. It depends what you want. Standard & Poor's, they call them spiders. Okay, there are over 1,000 ETFs out there. In the process, you have a lot of diversification, a lot like your mutual funds, but it really focuses a little bit differently in the aspect of how many that are out there compared to mutual fund. You have a discount that's selling for less than the FE. Okay, you have a premium sometimes, so you call one a discount, one's a premium, and then arbitrage, you're buying them both at the same time, trying to balance out your investments. A lot of people get into ETFs much more than any other thing. It can be addictive trading them because you have a chunk of diversity there, but you also can sit down and shift things much faster, kind of more than even a mutual fund in the process. There's a wide example of indexes. You have the domestic equity abroad, you have the commodities global, and you can mix and change them as you go through. My favorite probably is actually the bond, because I was looking when I was playing in the ETFs for some kind of security to balance out some of the crazy things I was doing over here and some different aspects of it. So it depends what you're into at the moment. Pay attention, what are your goals, define them, but explore them in the process. Some of the terms you need to know about this whole area: income distributions, unrealized capital gains, and then realized capital gains. And then what do you want to do with those different aspects of the gains and distributions? Do you want to plow them back in, or do you want them in your pocketbook? So it depends what you're doing. A lot of the ETFs, they really mimic indexes. Sometimes those really are very interesting, and they really can add some value because of the fact they're more predictable for big picture wise. But sometimes you may want to dabble, take that 10% mad money and experiment with it. So you need to know about discounts, premiums, and when to use arbitrage. It's all part of the aspect of mutual funds and even ETFs, but also in the aspect of just general investing all the time as to what you're doing and what you want to do and where you want your investments to go, grow, and glow sometimes in the process. Take care.